Picture this. Two guys, Tyler and Marcus, same age, 28, same neighborhood, same college, same starting salary of $52,000 a year. They even started their careers at the same company, sitting 3 desks apart. 2 years in, Marcus does something that terrifies everyone around him. He quits. No backup plan, people say? No safety net? He's throwing everything away. His parents stop sleeping. His girlfriend asks if he's having a crisis. His coworkers look at him like he just announced he was moving to Mars. Tyler stays, gets his annual 3% raise, gets promoted to senior associate, does everything right. Fast forward 7 years. Tyler earns $68,000 a year, has $31,000 saved, takes 2 weeks of vacation when his manager approves it. He's tired every Sunday night, and he couldn't tell you exactly why. Marcus earns $190,000 a year from a service business he built with a laptop and a phone, has $280,000 invested, takes time off when he decides to. He is tired sometimes too, but it's a different kind of tired. Same starting line, completely different finish. Here's the part that will make your stomach drop. Tyler is not the exception. Tyler is the rule. And the math, not the motivation, not the hustle. The math explains exactly why. If you've ever looked at your paycheck and felt like something doesn't add up, like you're working harder every year, but the number in your bank account barely moves, this video is going to make a lot of things click into place. My name is Rick, and I spend way too much time thinking about the invisible financial structures that trap smart, hardworking people in systems that were never designed to make them wealthy. I want to be very clear up front. This is not a video telling you to quit your job tomorrow. This is a video showing you the math they never put in the employee handbook. The math that explains why the 9-to-5 model is not the low-risk, stable path it was sold to you as, and what the people who figured that out are doing differently. If that sounds like something you need to hear, hit subscribe and give this video a like. Let's get into it. This video is for educational purposes only and does not constitute financial advice.
Let's start with a number that almost nobody actually calculates correctly: your salary. You hear $65,000 a year, and your brain registers $65,000. That's the number on your offer letter. That's the number you tell people at dinner parties. That's the number you use to feel okay about where you are in life. But here's the question nobody asks at the dinner table. How much of that $65,000 do you actually keep? Let's do the forensic accounting. First, federal and state income taxes plus FICA. Depending on your state, you're losing somewhere between 22% and 32% immediately. That $65,000 is now $46,000 in take-home pay before you've done anything at all. But wait, it gets worse. Now we subtract the cost of having the job. Commuting. The average American spends over 200 hours per year commuting. In pure dollar terms, gas, wear on your vehicle, parking, or transit passes, that's roughly $4,000 to $6,000 per year, depending on your city. Gone. Work wardrobe and maintenance. Business casual doesn't maintain itself. Clothes, dry cleaning, shoes that look professional, conservative estimate, $1,200 per year. Gone. Convenience spending. This is the category people forget. Because you're at work from 9 to 6, you're buying lunch 3 times a week because you didn't have time to prep. You're getting the $6 coffee to survive the 2 p.m. meeting. You're ordering delivery on Tuesday night because you got home at 7:30 and your brain has zero capacity to cook. These aren't luxury expenses. These are survival expenses generated by the job itself. Research consistently shows dual income and full-time employed households spend $5,000 to $9,000 more annually on convenience and food services than households with a flexible earner. Add $6,000. And then there's decompression spending. The Friday bar tab, the weekend trip you booked because you needed to escape, the online shopping at 11 p.m. that you barely remember. This is the money you spend to recover from the job. Another $3,000 to $5,000 conservatively. Let's add it up. $65,000 gross, minus $19,000 in taxes, minus $5,000 commuting, minus $1,200 wardrobe, minus $6,000 convenience spending,
minus $4,000 decompression. Your $65,000 salary is delivering approximately $29,800 in real, net, usable income. That's 45 cents on the dollar. But we're only halfway through the equation, because a wage isn't just money, it's money divided by time. HR says you work 40 hours per week. Let's be honest about what that actually means. You wake up 45 minutes early to get ready, that's preparation time for the job. You commute 30 minutes each way. You take a lunch break that you can't spend at home or with your kids. You're physically held captive near the office. And when you get home, you spend 30 to 45 minutes decompressing before you're functional again. Checking emails on your phone at dinner. Sunday anxiety about Monday. You're not giving your employer 40 hours per week. You are dedicating somewhere between 52 and 58 hours of your actual life to the employment arrangement every single week. So take that $29,800 real net income, divide it by 2,700 real hours per year, and your $65,000 salary becomes approximately $11 per hour in genuine take-home real-world value. The teenagers working the counter at the smoothie place don't commute 45 minutes each way. They don't buy business casual. They leave their stress at the blender. This isn't to be depressing. This is to be accurate, because you cannot solve a math problem you haven't seen clearly. Now here's where the comparison to Marcus gets genuinely uncomfortable. When Marcus quit and built a service business, in his case a digital marketing consultancy, he didn't just change his income. He changed the structure of how his income works. There's a concept in economics called the difference between linear income and leveraged income. Linear income means you trade hours for dollars. 1 hour of your time produces 1 hour of pay. If you stop working, the income stops. This is the architecture of every salaried job that has ever existed. Leveraged income means you build a system that produces money, not just when you're working, but as a result of work you already did, systems you built, or value you packaged in a way that can be sold more than once. The moment Marcus started charging clients on monthly retainers instead of an hourly rate, he broke the linear model. He was no longer selling time, he was selling outcomes. And outcomes can be systematized, delegated, and scaled in ways that hours cannot. Here's the tax dimension that most people never discuss. When you're a W-2 employee, the government taxes you before you get to spend anything. Every deduction, every expense you incur to do your job, the commute, the clothes, the phone you use for work emails, comes out of money you've already paid tax on. When you're self-employed or running a business, the IRS treats you very differently. Your business expenses, the laptop, the home office, the phone, the professional development, the travel to meet clients, reduce your taxable income before you're taxed. You're playing the tax game with a completely different rulebook. A self-employed individual earning $120,000 in gross revenue after legitimate business deductions may pay taxes on $78,000 of it. A W-2 employee earning $78,000 pays taxes on essentially all of it. According to IRS statistics of income data, self-employed individuals in professional services consistently report effective federal tax rates 4 to 8 percentage points lower than equivalent W-2 earners at the same gross income level. That gap, over 20 years, is not a minor footnote, it's a retirement account. Let's look at the wealth accumulation math directly. Tyler, staying in his job, earns $65,000. After the real costs we calculated, he has roughly $29,800 in usable income. He's a disciplined saver. He puts 10% of his gross away in his 401k. That's $6,500 a year going into retirement. Marcus, in year 3 of his business, is generating $130,000 in revenue with $40,000 in legitimate business expenses. His taxable income is $90,000. After taxes and business costs, he keeps approximately $68,000 in personal take-home. He invests $18,000 per year. A SEP IRA gives him a contribution limit more than double what Tyler can use. At 8% average annual market return, after 10 years, Tyler has approximately $101,000 in his 401k. He's done everything right.
After 10 years, Marcus has approximately $280,000 in investment accounts, nearly 3 times as much, on top of a business that itself has market value if he ever chose to sell it. Same country, same economy, same decade. The structure of how you earn determines the structure of your wealth.
Let's address the elephant in the room, because I can already hear the objection. But Rick, a job is stable. Quitting is risky. What about health insurance? What about the mortgage? I hear you, and I want to take that concern seriously instead of dismissing it. But here's what I need you to genuinely consider. What is the actual definition of financial risk? Most people define it as uncertainty. Self-employment is uncertain, therefore it's risky. But uncertainty is not the same as risk. Risk is the probability of a bad outcome multiplied by the severity of that outcome. Let me show you the actual risk math of the W-2 world. According to the Bureau of Labor Statistics, in any given year, roughly 1.7 million Americans experience involuntary job loss from mass layoffs alone, not counting individual terminations, company closures, or restructuring events. Over a 35-year career, the average American worker changes jobs 12 times and faces at least 2 to 3 involuntary separations. Here's the structural problem. As a W-2 employee, 100% of your income comes from a single source, your employer. One decision made in a conference room you'll never be invited into can eliminate your entire income overnight. No severance required beyond the legal minimum. No warning in many cases. You have diversified nothing. You have hedged nothing. You have built exactly one income source and called it security. Now contrast this with someone who has 3 clients generating income, or a business with 12 customers across different industries. For their total income to collapse, all 12 clients would have to leave simultaneously. That's not risk reduction by philosophy, it's risk reduction by mathematics. A 2021 study published in the Journal of Financial Planning found that households with at least 2 distinct income sources, not 2 jobs but 2 income-generating activities, experienced 67% fewer financial crisis events over a 15-year period than households dependent on single W-2 income, even when total income was lower. The most dangerous financial position in America is not being self-employed. It's being a single-income, single-employer household with high fixed costs and 3 months of savings. Tyler is not safe. Tyler is exposed, and the comfort of a regular paycheck creates exactly enough psychological sedation to prevent him from seeing it. There's one more dimension to this math that doesn't show up on any spreadsheet but is, I would argue, the most expensive hidden cost of all. Autonomy. When you work a 9-to-5, you are selling something beyond your labor. You are selling the right to decide how your time is used for 40 to 55 hours every week. You need permission to take a vacation. You need to negotiate for a raise. You need approval to change your schedule. Someone else sets your priorities each morning. This is not a small thing. This is your life, the actual hours of your actual days being allocated by someone else's agenda. Here's what researchers at Columbia University found in a longitudinal study of career transitions. People who moved from employment to self-employment reported, on average, a 47% increase in reported life satisfaction within 24 months, even when their income temporarily decreased during the transition period. The income came later. The life satisfaction came almost immediately. What they were measuring wasn't happiness about money. They were measuring what economists call autonomy value, the psychological and practical worth of controlling your own schedule, choosing your work, and removing yourself from the permission-based economy. Now, I want to be very honest about something. Not every person who quits their 9-to-5 wins. The failure statistics for new businesses are real, and you've probably heard them. But here's the nuance most people miss. The survivorship-adjusted income data still favors self-employment when you look at 7-year outcomes rather than 1-year outcomes. The people who navigate the transition successfully don't just match their former salary, they typically surpass it and keep a structurally larger portion of what they earn. Marcus didn't win because he was smarter than Tyler. He won because he changed the rules he was playing by. So what does this actually mean for you practically? Because I'm not going to end this video with a motivational speech and send you into your Monday morning unprepared. Here's the framework that the people who make successful transitions actually use. Step 1. Calculate your real hourly wage. Do the exercise we did earlier, honestly. Take your net usable income after taxes and work-related costs. Divide by your total real hours committed to employment. Write that number on a piece of paper. Put it somewhere you'll see it. That number is your baseline. That is what you are currently charging for your time. Step 2. Identify your transferable skill. You don't build a business from nothing. You take something your employer is already paying you for, and you find a way to deliver that value directly to a market. Marketing, accounting, coding, sales, project management, operations, writing, design. These are skills that exist in every industry and can be delivered as a service. Your employer has been packaging your skill and selling it at a markup for years. You can learn to do that yourself. Step 3. Build the bridge before you burn it. The people who crash out of employment and fail are usually the ones who quit first and figure it out second. The people who make the transition successfully start building on the side. 1 client, 2 clients, $500 a month, then $1,500 a month before they ever hand in their notice. The threshold most financial planners point to, when your side income reliably covers your core fixed expenses for 3 consecutive months, you have a real decision to make. Before that, you're still in preparation. Step 4. Restructure your cost base before you need to. The fatal mistake people make when transitioning is trying to maintain a lifestyle built for 2 incomes or a stable salary during the variable income phase of building something. Lower your fixed costs before you need to. This is not deprivation. This is buying yourself the runway to make the math work. Step 5. Understand the tax game change. On day 1 of self-employment, consult with a CPA who specializes in small business taxes, not a general accountant, a small business specialist. The difference in what you can legally deduct, how you structure your business entity, and how you manage quarterly estimated taxes can literally determine whether your first year succeeds or fails. The IRS is not your enemy here. The tax code for small business owners is genuinely favorable, but only if you understand it. The people winning this game didn't win because they were brave. They won because they did the math, built a bridge, and crossed it when the numbers told them to. Let me bring this back to Tyler and Marcus. Tyler is not a failure. Tyler is doing exactly what the system designed him to do. Show up, stay, accept the annual 3%, and call it security. The system works perfectly for Tyler's employer. The question is whether it works for Tyler. Marcus looked at the same math you just heard. He looked at his real hourly wage, his single income dependency, the permission-based structure of his days, and he decided to change the rules. 7 years later, the math doesn't lie. You don't have to quit tomorrow. You don't have to burn anything down. But you do have to look at the numbers clearly, because you cannot make a good decision with a distorted picture. If this video shifted how you see your relationship with your paycheck, give it a like and hit subscribe. We're going to keep running the numbers that nobody in your HR department wants you to see. There's a video right here on why your savings account is quietly taking money from you and what to do about it instead. That one connects directly to what we talked about today. And remember, the trap doesn't feel like a trap. That's exactly what makes it so effective. See you in the next one.